Thank you for joining today's webinar, which is covering dairy margin coverage, the agricultural risk program, and price loss coverage. You may know those as DMC, ARC, and PLC. My name is Matt Lippert. I'm the regional dairy educator for Clark, Marathon, and Wood counties in central Wisconsin. Please use the question and answer function to ask questions for our speakers. So our first speaker today is going to be Leonard Polzin. Leonard is the Dairy Markets and Policy Outreach Specialist for UW-Madison Division of Extension. Leonard grew up on a century-old Wisconsin dairy farm. He has held positions in both public and private sectors and takes pleasure in applying research to industry scenarios. With considerable experience as an educator and analyst, he has developed and delivered programs covering a wide range of topics, including market analysis, outlook, market expectations, risk management, and policy analysis. So Leonard, you're going to talk to us, I believe, about DMC.
Well, perfect. Thank you very much. Appreciate it. Happy to be here today. So I think as we take a look at dairy margin coverage this year and what it will, kind of look like and how we're making those decisions, I think it's important that we kind of take a look at a general overview or, high level considerations of what this idea of risk management is, right, and why why we do spend so much time and effort and thought in this in our businesses. So when especially on the dairy side, when we look at what some of our options or considerations are in risk management, that first one is doing nothing. We call this being self-insured. So I think that that's definitely an option to consider, especially considering the type of operation you are. Maybe you have a strong balance sheet, diversified revenue sources. Maybe there's, other things that make you less sensitive to market changes relative to some other folks in the dairy industry, right? So certainly a consideration, that's for sure, but may not be the right choice for everyone. From there down the list, we have futures and options, so CME contracts there. They have their own set of unique characteristics with them. Some they do have maybe additional complexity or attention that needs to be given to them when placing those positions in the market or utilizing some professional services with that. Another option or selection is that cash contracts with co-ops or plants where you can kind of lock in some of these prices, whether on that input side, potentially you can use some cash contracts to manage your price risk on that feed side, but then also maybe if your plant or if your handler does have some of these contracts available to you, they could be a choice to consider as well. Another one that is growing in popularity is DRP, Dairy Revenue Protection. So a key word in that is revenue. So as we go along here, we'll talk about margin a lot, which is that income or is that revenue portion minus the cost in order to get to that margin calculation. With DRP, it is purely on that revenue side of that calculation. So that's important to consider when you're looking at maybe a holistic or an encompassing set of risk management decisions. LGM dairy, livestock gross margin dairy, does that. It does have the revenue side as well as that cost side that accounts for feed cost in that insurance product. And the one that we're here to talk about today is dairy margin coverage. So it operates as kind of the same mechanics as an insurance product would, but technically is not an insurance product. It's a program, as we all know, that's offered through USDA, FSA, Farm Service Agency. So for some of those folks that may be familiar with the lineage of the program, it is the revised MPP dairy program there. So I mentioned this a little bit, but kind of taking a look at what our risk management tools are actually doing. Whenever evaluating risk or seeing how to offset some of that, we're trying to answer kind of two basic questions. The first one is what risk are you managing? And the second is what is the value of doing so? When we talk about risk, there's a lot of ways to define it. But what we're generally looking at is kind of this basket of things on the left-hand side of the slide. Production risk, prices, markets, financial risk to you in your business, institutional risk, whether that comes from legal policy, things like this, human or personal. And again, what we're kind of looking at managing is either a portion or the entirety of these three portions of this calculations: income, expense, to get to some sort of margin. So to kind of circle back or break it down of what tools in our toolbox we have if we're going to margin or if we're going to manage income, expense, and margin. On that income side, again, we can use those futures and options, CME contracts, DRP, dairy revenue protection, and then those, cash contracts, locking in those contracts, those milk contracts with your processor, with your handler. On that expense side, again, we have futures and options that are available to us there that can help manage some of that exposure, and then again, contracts as well. And then margin, kind of the two tools that we have available to us that do both of these things at once are LGM dairy, livestock gross margin dairy, and the product we're here to talk about today, dairy margin coverage. So as we kind of take a look at dairy margin coverage, let's look at the mechanics of it a little bit and some of the key takeaways and considerations for this year. The big thing is that in this program, due to the political circumstances that surround us at the moment, there has not been a new farm bill, which means that all of these programs are simply a continuation of what the previous programs were. So there was a continuing resolution passed that extended these programs in more or less an as-is state. That enrollment is now open for. So enrollment for dairy margin coverage is January 29th through March 31st. If you're going to take any notes here today, make sure that you note that March 31st deadline. So that is when you need to sign up by. To enroll, to sign up, head down to your local FSA office, and they'll be able to set you up with all of the details and paperwork necessary there. So again, all the mechanics are the same this year, and the basics of the program is that it uses a milk price, which is our national all milk price, minus some feed value, which is a calculated ration based on what's required to produce 100 pounds of milk, and which does not include the fortification, mineral, salt, things like this, etc., milling cost. But it uses reference prices to back calculate what that theoretical ration cost would be. And then what it does is it uses the all milk price minus this reference feed cost to calculate a margin. And then, as we'll see in a second here, you can set that margin coverage level that you would like. And then based on the difference between that margin and that margin coverage level, if the margin falls below that, then a payment is issued of the difference between those two things. So the big takeaway from this slide that I want to point out is that the 25% premium discount on premium rates for lock-in coverage does continue for the 2024-2025 program for all pounds of adjusted base production history. When again, still on this kind of mechanics of the program, we said that we have these coverage levels. Well, those coverage levels break down into their corresponding premiums for two different tiers of milk production. So tier 1 is that first 5 million pounds of annual production, and tier 2 is everything above that amount of production. So if we just kind of follow the flow chart here on tier 1, for your first 5 million pounds of production or less, you can select margin levels from $4 to $9.50. And the premiums then, correspondingly increase all the way from 0 to that 15 cents per hundredweight. It is important to note that all producers can enroll at that catastrophic coverage level, which is the lowest one there, which does not have a premium associated with it, but it does have a enrollment fee of $100 unless waived. For details on that, feel free to contact your FSA office. But it is a benefit of the program to enroll sign up simply for that, even if no additional coverage levels are selected. And again, on that tier two, 5 million pounds and above, margin coverage levels range from $4 per hundredweight to $8 per hundredweight. And then again, with corresponding premiums that increase incrementally from 0 to $1.80, we'll call it 81 cents per hundredweight. So big questions that we always get on dairy margin coverage is, what about production history? When do we get to update it? When do we get to change it? So this kind of lays out all of the language that FSA has provided on this topic of adjusting or changing production history. So the kind of big takeaway from this is at the very bottom of the slide, in that eligible DMC dairy operations that did not previously establish a supplemental production history or adjusted base production history in 2024 may do so in 2025. Here's kind of a flowchart diagram of what that looks like. Again, we're not saying that production history is updated. We're saying that there's eligibility for supplemental coverage if it has not already been selected by the producer. Again, since this is a continuing resolution, which perpetuates the previous set of rules from the previous Farm Bill, no major changes to this. But just to kind of walk through the logic here, so in 2011, 2012, and 2013, base production history has been set off of that. So whatever the highest milk production was in those 3 years. And then if we jump ahead to 2021, 2022, and 2023, producers were able to update their production history by using this supplemental production history. Now, in 2024, what FSA did is they said, hey, let's take your base production history, which is, again, those first 3 years of the highest of 2011, 12, and 13. Let's add that supplemental history, if you elected to do that in 2021, 22, 23, to create this thing called your adjusted base production history. Now, what FSA is saying for 2025 enrollment is that if you have not selected supplemental coverage or supplemental production history in 2021, 22, or 23, then, and if you don't have the adjusted base production history in 2024, then you can now, in 2025, again, select this supplemental coverage. So if you've already done it, as this logic model kind of walks through here, if you've already had supplemental coverage there and elected that, you are not eligible to do so again in 2025. But if you have already done that, if you have not already done that in previous years or have that adjusted base production history in 2024, you can now utilize that in 2025. The big takeaway here is that it only applies to your first 5 million pounds of production. So if you're already above that 5 million pounds of production, then the electing supplemental coverage or supplemental production history really has not eligible to do so at this time. So I think especially right now, as we look at what some of the market forecasts are showing us as anticipated payments for 2025, I think it's important to take a look at historic performance and where our forecast is, so that way hopefully people can have as informed decision when selecting to enroll this year as possible. So this is just, basic graphing out of where our all milk price, final feed cost for the program, and where our margin was for this program since 2019. So if we take this same graph and then we just overlay some of these gray shaded areas, that's where we have seen payments or where payments have been issued at that $9.50 coverage level over this same time period. And if you notice, there is quite a bit of gray relative to white areas on this graph here. So if we kind of break it out and represent that in a different way, these blue bars represent the payments that occurred in those months over this time period from 2019 all the way through November 2024. A couple interesting takeaways in this is that we see when we do receive payments, more often than not, we see payments occur in many consecutive months. For example, in 2019, we saw 7 months in a row with payments. And then as we got into 2020, kind of a more unique situation, we had 3 months with payments, followed by a fairly decent period with good margins, and then 12 months of DMC payments in 2021. 2022 was much better, but then if we skip ahead to 2023, we have 10 months in a row, almost 13 if you include into January of 2024 months of these payments. So on average, over this time period, when we do receive payments, that prolonged period of we'll say margin pressure seems to average about 5.5 months. And then conversely, when we have periods of good margin, they seem to last approximately 5 months in length, right? So I think a good takeaway from this is that, we do in dairy very often see this pendulum swing, right? From high margin times to low margin times. And, when we do get into these periods of low margins, it's not uncommon that we see them happen for a prolonged period of time. The takeaway message from that is that when you are looking at making these risk management decisions, take into account that we have had very good prices in 2024, very good margins here, and that if and or when that pendulum does swing again, it would not be unlikely, at least according to what we've historically seen, that those margins will be prolonged prolonged period of time before the next recovery does come back. So just kind of some key findings or takeaway from this. When I ran the math here, the average payment per month is $1.17 per hundredweight. The highest payment was almost $6 a hundredweight. And, I think just even visually, you can see this, that the payments are triggered in over half of the months over this time period. So almost 53% of the time, some sort of DMC payment was made at that $9.50 coverage level. So the median payment is approximately 15 cents, which is interesting enough, almost exactly equal to the premium at that $9.50 coverage level. So if you kind of do the math and figure out the net benefit from participating, where we take that average payment of $17.17 per hundredweight minus that premium or the cost of participating at that $9.50 coverage level, we get a positive net benefit of over $1.02 return from participating in the program over that period of time. So now, just to kind of show that we're not cherry picking time frames here, to look at the same exact sort of logic or math since 2000. So if we look at 2000 through present, we can see that the number of payments triggered, right, per this 288 month time period is 70% of the time we're seeing payments being made. So and the average net indemnity over that entire period of time is that $1.40 average net indemnity, which includes that cost of participating in the program, is $1.46 per hundredweight. So I think, all of this to say that the program's been very beneficial at providing that price support, and seems to have proven its ability to really support those margins during those periods of time when, prices have really shifted. Um, so as I said at the beginning, right now, 2025, we're looking at no forecasted payment. So, uh, and coming off of 2024, where we didn't have very many payments at all. We did in the first 2 months of 2024, and then we had pretty solid margins after that. I'm sure some producers may be considering not enrolling in the program this year. So what I wanted to do is take a look at, I went back and for every enrollment period in these 4 years, took a look, looked at what the forecast was for payments at the time of enrollment, and then looked at what the actual historic payments were. So starting at the bottom in 2022, much like this year, there was no payment forecasted, and we ended up with a payment of $2.30 per hundredweight. In 2023, not terrific margins were forecasted at almost $7 per hundredweight. And we actually ended up with $33.67 in total payments per hundredweight over that time period. In 2024, at the time of enrollment, we looked at $1.19 per hundredweight. And at the end of it, we were a little less than that, but not too far off at $1.08 per hundredweight. So simply because we are not forecasting a payment in 2025, that does not always mean that we won't see one once the calendar year closes. So, and I can say that anecdotally, as we go back and look at this even further in previous years, from conversations I've had with folks that have been around the program for some time, these sorts of observations are not unique. We've seen program payments have much higher end of year results than what they were originally forecasted many times. So when we kind of take a look at what impacts these payments, right, and what kind of market forces or factors, are kind of the drivers in that margin, we did some regression analysis to see where those impacts are mostly coming from. So as you would expect, a big portion of this, or a big portion of that relationship between, a change in one of the variables and the result in margin, milk price, right? It's a one-to-one relationship, as we would all expect. That's the income side, that first calculation. So we would expect that it would have, a direct one-to-one relationship with margin calculation. What's interesting, though, is we take a look at some of the other factors that go into this, income minus expense or income minus feed cost, right? What these changes in feed cost market values will do to margin. And we see that changes in corn price do have a strong effect, greater, like a $1 change in corn price changes that margin by greater than $1, right? So, we get a fair bit of sensitivity coming in from that side of the market. Soybean meal and premium alfalfa are used as less portion of that calculation in that total ration. So we would expect that we would see some, smaller or not as great impacts on margins based on changes in those calculations there. So as we kind of take a look at where, like I said before, we look at forecasts and we look at where we're sitting at the moment in order to kind of make what a good decision would be for us. I just kind of listed out the bulls and the bears in the market at the moment. And, when we look at, a bundle of fundamental factors, we have a few bull factors, but really the bears kind of win the day in total number of factors that we're considering. Some of the greatest risks at the moment are policy changes. So some of the work done by Dr. Chuck Nicholson recently published shows that, depending on what sort of new policy is implemented, whether it's tariffs or changes to food assistance programs, labor policy, we could easily see changes in that all milk price ranging from anywhere from 10 cents to $3 per hundredweight. And then one thing we know that will be coming in 2025 is the changes to federal milk marketing orders, and it's likely we'll see a 30 cent per hundredweight on all milk price decrease from that as well. So just kind of taking a look at where this forecast is, the forecast margin at the moment is that orange line. And then kind of taking into some of these, adjustments to the forecast, I kind of made, and this doesn't include any of the policy decisions that could be made. This just kind of includes what we would expect from our likely changes in class 3 utilization, some likely changes in feed costs. We're much closer to that $11 per hundredweight margin, where, before currently the model has it forecasted closer to that $14 per hundredweight. So if you want to take 11 and then take, you know, $3 more dollars off of that, it doesn't take a lot of from policy changes. It doesn't take a lot of market forces to keep pushing that margin lower. So if you're interested in taking a look at your own operation and entering your numbers and seeing what your forecasts is, and seeing what your premium would be, you can do so at this link here. So dmc.dairymarkets.org. And when you arrive there, you'll get a website that looks very much like this. So when using this tool, a few things to consider. Across the top, we have your coverage selection. This is what's going to give you, your premium. You can enter your own historic production, select your coverage level. But when you're doing this, one thing to consider here is that in this drop-down menu, make sure that you have the current years selected. Otherwise, it will pull in previous year's data. So take a look, make sure that 2025 is selected in that drop-down menu there. And then just quickly going across the top, you can look at your net benefit forecast, your price forecasts, historic performance, and then what some of those payment trigger analysis would be. And then again, here in the middle of the screen, you can see based on that, on your different coverage levels, what your premium would be given the amount that you enter in the top for your annual historic production. So this is available online as well, but we wanted to bring in some hopefully useful links and references as you take a look at some of your risk management tools, everything from the online decision tool to FSA office locations to some potential other risk management tools such as DRP, LGM Dairy, etc. So with that, I'm happy to take questions if there's any that are burning at the moment. Otherwise, we can have Silva take the reins and then answer questions at the end.
Well, I'll ask you a couple right away, Leonard. So it's my understanding that this is relative in the country. This has been a really important program for Wisconsin as the second largest dairy state, but with a smaller average herd size, that a lot of the those payments you've been talking about have come to, I think we're the #1 state for receiving money from this program.
I think that's very good assumption. Yep.
And when you went back to 2000, but the dairy margin coverage wasn't available all the way back in 2000, was it?
So I would have to go back and check on that. This current iteration of the program was back to 2018. And then what this tool does is pull in, what those prices would have, what the prices would have been, right? So,
Right. And then I don't know if you put it that simply, but this is funded by government subsidy and also by producer payments, insurance premium.
correct. Yep.
And the tier two is much less subsidy and much more producer funded.
Correct. Yes. So at
So go ahead.
Yep. So you can see here that that tier one is kind of that salmon or pink section, and then tier two is kind of that darker choice or that darker portion on the right hand side of the slide.
So the tier two is it's utilized, but it's much less appealing, and most of the payments have come out through the tier one payments. Is that correct?
Correct. Yep. Yep.
And then in this country, the way our dairy industry is structured, uh, is there more farms producing milk that are or more cows or more milk production coming from farms that produce over 5 million pounds a year than milk coming from smaller farms?
I mean, certainly that's the case, right? Like the majority of our milk comes from large the small number of large farms, let's say, right, do produce more milk than the larger number of smaller farms. So I think that's a very safe thing to say as well. Yep.
All right.